Thank you for joining us for our fourth quarter outlook. As the third quarter drew to an end, all eyes were on the Federal Reserve as the September meeting came and went without a change in policy. Now, it's been almost 9 years since the last Fed rate hike, and it's our belief that in either the December meeting or in the first quarter, we're going to see a hike. The biggest news, however, in the quarter was the sell-off in equities. And unsettling as those sort of sell-offs are, it's our belief that what we experienced was just a normal correction in a bull market and not something signifying the end of the cycle. To try to put a little illustration on that point, we plotted all of the returns on the S&P over time since 1980, and the average return over that 34-year period has been 10%. What's interesting, however, are the red diamonds. The red diamonds indicate the biggest sell-off intra-year in any given year, and what is illustrated here is what we all know and feel, is that stocks are volatile. The average decline in any given year is 14%. And what we experienced in the third quarter, as we said, though unsettling, was very average with a sell-off of 11%. Now, it had been 4 years since we'd had a sell-off of more than 10% on the S&P 500, but again, something very typical and very average and not signifying the end of a cycle in our opinion. What caused this was concerns over a slowdown in China. Now, China is the second largest economy in the world, matters, but our belief is that in no way is a slowdown in China going to cause a recession in the U.S. If you break down the U.S. GDP, 2/3 of it is comprised of consumer spending. Only 13% of the U.S. economy is dependent upon exports, and of that, only 7% of the exports go to China. So 7% of 13.4 is 0.9%. In other words, if exports to China were to go to zero, 99% of the U.S. economy would not be impacted. Now, that's, of course, understating how much the impact would be, because if China has a real growth problem, it's going to impact many countries that we do business with other than just China. But the point is that right now that we're paying attention to China, it is not something that's going to tip us into recession by any stretch. On the other hand, there are significant parts of the world that are very directly tied to China, particularly commodity-based economies. For instance, 35% of Australian exports go to China, 19% of Brazil's, 25% of Chile's. As such, not only do we not have any direct investment in China right now in an international model, we're also underweight emerging markets, and we're avoiding those commodity-based economies that we've outlined, as well as in our domestic portfolio, with the exception of oil, underweight commodities, because not only is China slowing, they're reallocating their efforts in their economy, rebalancing, if you will, moving away from a manufacturing and export-oriented economy to one that is more consumption-based. So the commodity complex is going to be under pressure for some time, in our opinion. The U.S. economy, on the other hand, is in great shape. And as we pointed out 2 slides ago, 2/3 of the U.S. economy is based on consumer spending, and the consumer can't spend if they're not employed, and they're certainly employed right now. The unemployment rate has fallen to 5.1%, which in Fed terms is nearing full employment. That's the lowest unemployment rate in over 7 years. Now, what we don't think has been fully appreciated is how broad-based this improvement has been. And to put a finer point on that, we've segmented the unemployment rate based on education. And as you can see here, the blue line indicates unemployment rate for those without a high school diploma. Unemployment rate has fallen from 16% to 8%. With a high school diploma, the unemployment rate has fallen from 10 to 5, associate's degree from about 8 to 4.4, and bachelor's degrees, the unemployment rate has fallen from 4.5 to 2.6. So essentially, across the board, across the socioeconomic and demographic mix here based on education, it's been essentially halved, the unemployment rate. So people are employed. What's different this time is that we haven't seen the requisite sort of pickup in wages given the decline in unemployment. And to illustrate this, we've plotted the unemployment rate in green and the wage growth in blue. And historically, these are almost perfectly negatively correlated, meaning that when one is going up, the other is going down. Intuitively, that makes sense. When unemployment goes up, wages go down. When unemployment goes down, wages go up. And what's a little different this time is we've had a dramatic improvement in the unemployment rate, yet a very modest sort of pickup in wages. And why is that? 2 reasons. One, more than ever, labor is a global commodity, and there's an excess supply of labor globally. Number 2, the labor participation rate, or that is what percent of people that are able-bodied are actually in the workforce and looking for work, is relatively low by historic terms. As such, when wages start to pick up, it brings on people from the sidelines into the market. So the pickup in wages has been slow, somewhere around 2% right now. We're starting to see that trend up a little bit. We believe this is the last thing the Fed is looking for confirmation that they'll be comfortable to raise rates, and we think that's going to happen here as we progress into the fourth quarter and certainly into the first quarter of next year. Now, when rates do start to go up, however, they're going to climb slower and to lower levels than we've seen in previous cycles. As an example, the last Fed rate hike cycle was between 2004 and 2006. During that 3-year period, we saw 17 quarter-point rate hikes by the Fed, taking Fed funds from 1% up to 5.25%. Based on the most recent Fed governor testimony, there's an expectation that this cycle, over the next 3 years, will see Fed funds go from essentially 0 to 2.5%. So rates will be slower and lower in their climb. Nonetheless, higher rates have caused us to position our portfolio to underweight interest-sensitive sectors and asset classes, and we think that's going to be an appropriate position as we progress into the fourth quarter and into 2016. Other major macroeconomic theme has been a point of view on energy. Oil prices, of course, have been in the news very much. At some point in the first quarter, we thought that the sell-off was overdone and we went to an overweight in energy. Until recently, that hasn't been a rewarding trade, but it's starting to pay off in spades. And when you look at oil prices, it's really Econ 101, supply-demand, very simple. When prices are high, it causes production to increase and demand to decrease, driving prices lower. Low prices, on the other hand, cause production to be diminished, and we've seen production here in the U.S. in terms of oil rigs cut by 60% over the past year and a half. And when low prices prevail, demand picks up. And we've been seeing that. Gasoline consumption's up 7% this year. SUV sales are at record highs. So we think we're right here in this portion of the cycle where the lower production and increased demand is causing prices to rise. We finally started to see that the last week to 10 days. WTI has gone from $42 a barrel to $50. So we think we're right here. We think this is the right place to be, at least at this point in the cycle. With respect to stocks, we think we're going to continue to be in a trading range until investors start to really discount higher earnings, at least confidence in higher earnings. What we've plotted here are earnings, actual earnings going back on the S&P 500, which right now have been running at about $119. The dashed lines indicate expectations for 2016, which are running at about $130. And over time, if you plot what the S&P has done, investors have behaved rationally. In other words, as earnings have climbed, so too has the S&P. When earnings have rolled over, so has the market. What stands out, of course, is the sell-off in the third quarter. And this is going to be corrected one of two ways. Either the sell-off in equities means that investors have correctly discounted what is going to be a reduction in earnings expectations for 2016, or that this is overdone, and as investors start to discount higher earnings next year, stocks will go up, which is our base case. Now, there's reasonable concerns about slow growth abroad impairing sales and also a high dollar impacting exports. Certainly that's going to be a drag on earnings, but we don't think that it's going to be a significant reduction like we saw last year. As such, we remain bullish on U.S. stocks. We think this is a correction, and it's going to be rewarding here as we progress into the fourth quarter. So to wrap up, a consumer-led U.S. economy continues to be the strongest in the globe. China's not going to derail that. Fed rate hikes are coming, but they're going to be very modest, and though rates will be rising, they won't be dramatic. Domestic equities are going to be range-bound until we get some confidence in earnings in 2016. And as such, we continue to favor equities over bonds. And within equities, we like small-cap U.S. as well as large-cap U.S., developed market international, that we're underweight emerging markets, and anything that's interest sensitive. Thank you so much for your time and attention. Have a great winter, and we look forward to catching up with you in the new year.